Like the whole conversation with crypto right now and people becoming crypto millionaires, like, cool, that's great. They made a bet and they were right and good for them, but they didn't invest. And they did put their original capital to a lot of risk. Hello and welcome back to the Main Street Patriot Podcast. Today's episode, we are going to be talking about one of my favorite subjects, and it is this. Lessons learned from losing $1 million. As always, I got my producer Jake on. Jake, what's going on?
Yo, Jimmy, got the mobile man cave almost ready to go, so I'm pumped. This Sweet. Is the mobile podcast studio.
Yeah, Jake has crafted himself a mobile podcast studio. So will there be recordings where you pull it up in my driveway and we record that way?
Absolutely.
Very interesting. The neighbors will love that.
It's huge. It's black with gold Doorwood Studios on it. So I think they're going to be like, what is going on over there in the Vreeland household?
Nice. We last year we did an office Christmas party and we had like 30 people over the house, and then we went to we did a party bus. Yep. And something happened with the order and it was wrong, and it was like became a real like travel bus. Like if you were going to go to Chicago or something. But the neighbors looking when that pulled down the street and then like 30 people loaded into it, it was one of the highlights of my Christmas season.
That's amazing.
What about the landing page? Do we got the landing page up yet that we can tell people to go to?
The link is live. It's jimmyvreeland.com/get started with real estate.
So after you get off this podcast, you're like, man, this is the smartest guy in real estate ever, and I got to invest with them. Click that link, and that's how you get started with our team. So let's get into it, Jake. I remember listening to this book like 3 or 4 times. Where the first I ever heard about it was on the Tim Ferriss podcast, and then next Nassim Taleb talked about it on Anti-Fragile and the Black Swan. But it's a book called What I Learned Losing $1 Million by Jim Paul and Brendan Moynihan. Now, Jim Paul is this like 1990s, early 90s trader, like swinging for the fences, day trader. He's going up $1 million, he's going down $1 million in like weekly basis. And then Brendan Moynihan is an economist. And Jim Paul's telling his journey, and then Brendan Moynihan is talking about what he's doing wrong economically, really mentally, emotionally, and, all the cognitive errors that he's making. So it's a fascinating how do you think book.
Right. Well, the toughest lessons really come from the mistakes we make, so...
And so Jim Paul was kind enough to let everybody learn from his mistakes. And there's no way I would have got into this real estate game without this book and understood how to do certain things. So we're going to get into that during this podcast.
All right. I'm ready to go.
And so, Jake, do you ever have the question in your mind, like everybody's like Wall Street's a casino, investing just seems like gambling, people are making bets, and then you'll hear a guy like Ray Dalio actually say it's making bets. Like, do you think there's some lack of clarity between gambling, betting, speculating, and investing?
Yeah, absolutely. I mean, it does seem like Wall Street is just gambling. You don't have any control over it, and so I mean, I would agree. It seems like there's a lot of gray area here.
And then we're recording this in April of 25. Trump is in office. Trump is enacting tariffs, and just this week, Trump put something out on Truth Social, like he's going to lower tariffs, and the market bumps 1,000 points. Yeah,
I mean, it does really seem like, hey, bet red or black. Like you really can't control anything.
I am not a Wall Street guy. I am a real estate guy. Full disclosure, I don't have any money in the markets, and like people think that's crazy. Subject another podcast on how I got there. But I still think the stock market's great because it creates liquidity for the most abundant, robust economy on earth. So when I hear people talking smack about the stock market and saying it's a fugazi and whatnot, I don't necessarily agree with that. But I think it comes from the fact that I think it comes from the fact that we got to get some clarity and define and be precise in our speech on betting, gambling, speculating, investing. So that's what I want to spend the time on this podcast doing.
Cool. I like that.
All right, we're going to have to go straight Jordan Peterson for like a couple minutes of this podcast. So hang in there with us, but I got to be very precise in my speech and I got to explain, I got to define some terms. So give me 7 minutes to do that. Is that all right, Jake?
I love it.
Oh,
I remember this interview with Jordan Peterson and this like Canadian news anchor, and she kept on trying to like trip him up and make him say things that he wasn't actually saying. He's like, no, let me be very precise with my words.
we need to do a podcast on 12 Rules for Life, one of my favorite books.
Yeah.
I actually have 12 Rules for Life in my kitchen for my children to see all the time.
Nice.
But rule number 5 is be precise in your speech.
Yes.
And so I'm going to define some terms. I'm going to define external losses, internal losses, distinct events, continuous processes, inherent risk, and creative risk. It's important to have these definitions before we go into the next set of definitions of gambling, betting, investing.
All right, buckle up. Let's go.
Okay,
7
actually,
minutes.
it's rule number 10.
Okay.
So first, let's talk about the two types of losses or wins.
Okay.
And now there's internal losses and there's external losses. And you're giving me the puzzle look, Jake. So an external loss is a loss such as a bet, a game, or a contest. It's an objective fact when it's the same for you, me, and everyone else. Like, it's very clear and it's not subjective or open to individual interpretation. Like the Chiefs winning the Super Bowl 2 years ago and losing this year were, well, when they lost, it was an external loss, but it's an objective fact that they lost, right?
Mm-hmm, mm-hmm.
And they got smoked so hard, it's not really open up for interpretation. Because sometimes they'll be like, oh, the ref made a bad call, we really won that game, right?
Right.
Now, an internal loss are losses that, sorry, this slide's wrong if you're watching on YouTube. But an internal loss is a loss that is like a loss of self-esteem, loss of personal value, loss of love. It's very internal and it's open to something very subjective.
Okay, so it's like it's all your interpretation of the event. You could be like, well, I lost this job, but actually it's a good thing because of X, Y, Z reason.
Yes.
Okay.
And now there are internal losses. If when my daughter tore her ACL, it stung more than just her being injured, right? And I'm sure it stung even 10 times worse for her.
Yeah.
Like, there are bad events that happen. You're in a car accident. Like, that's going to probably be an internal loss. Like, you lose a loved one. That's going to be an internal loss. Now, the degree to which someone feels that loss is going to be a little bit subjective. But does that kind of make sense?
So is it just saying that it's the difference between sort of quantitative and qualitative? Or
no, it's when you have an external loss, you don't really care, and it doesn't reflect on your self-esteem and who you are or your identity.
Okay.
Now, an internal loss will be the hey, my identity's been compromised. Like, I don't think as highly of myself as I did yesterday. Something of that nature.
Got it. Okay. So really, there's like an emotional. I guess there could be emotional response to the Chiefs losing so embarrassingly, but
yes,
but. That's just like your problem versus, yeah, okay.
And
I'm with you.
Get into that when you cross your wires.
Got it.
So set that side for a second. So now you have discrete events and continuous processes. So a continuous process is an activity with no defining endpoint. Like, for example, we have a video game system in our house, but I'll let my children play sports games, but no Minecraft, no games without an ending.
Mm-hmm.
And so that's probably me being a little paranoid from reading this book, but I don't want a continuous game where there's no defining endpoint and the child can play the game all day.
No, I like that. We need closure.
Exactly. And now a discrete event is like a football game. The whistle blows, it's over. A jiu-jitsu match, a boxing match, the bell rings and it's over. So there's a discrete event.
Okay.
Now, here is where this becomes important and people cross their wires. Losses from continuous processes are much more prone to be internalized because like all internal losses, there's no ending point.
Wow.
So maybe in the back of my mind, that's from Jim Moynihan. I know it's a really profound statement. That's I'm not smart enough to come up with that.
That's cool. I never thought about that.
See, yeah, pretty interesting, right?
Yeah.
Okay. Now that's a double-edged sword. The participant, and with continuous processes, the fact that you can constantly be winning and losing is a double-edged sword because it's a continuous process. So you get to the glory of a continuous process is you can take discrete losses and learn and make new decisions in a continuous process.
Sure. I mean, we always talk about like, you're raising kids and you're taking them to baseball or whatever. And it's just like, there's the whistle blow. Hey, you show up next time. What'd you learn? Apply it to this one. It's like the last one never happened. But that thing about the continuous process makes it really hard to treat it otherwise.
Right. And now this is what's important for investors. When an investor takes an external loss, so if you make a bad trade in the market and you lose, great traders, win or lose, don't take it personally. It's just business to them. And so they're able to remain objective. They're able to, I'm going to jump ahead a little bit, but at the end of the day, when you're a passive investor, your number one job is to create an investing criteria and adjust it and follow it. But because you're not doing the work, all you can do is make decisions. It's a complete mental construct.
Right.
So where investors get tied up is they have a loss in the market and a discrete event, which should be a discrete loss, and they should be able to move on, but they internalize it. And then even discrete wins, which should just be a discrete win, a data point to get added to their investing criteria, they take it as they're the smartest guy ever. I've made this mistake in my career so many times, and then they're not able to see when the next bad thing is on the horizon.
Right. Yeah, you talk about like how houses can I forget the term that you use, but basically a defined loss, and that's okay. Or I mean, a bad haircut maybe is the term you use.
Real estate's like a bad haircut.
Yeah.
Time will solve everything.
But yeah, over 10 years, like, okay, it's appreciated in value, whatever else. And so not to internalize that initial bad haircut, because it'll just be solved with time. Man, yeah, so now I really understand why I use that term, getting the wires crossed, because so many people, and I've done this so many times in my own business career, where you reflect it on yourself, and even though it's just another round of boxing.
Yeah, now maybe you are doing something internally that is causing you to have these discrete losses. Like maybe you're not conscientious enough. Maybe you're lazy. Maybe you're all those things. But those are just going to result in discrete losses. And you can improve that in the continuous process. So discrete losses can also be a symptom of, hey, maybe there's something internally I need to adjust.
Yeah.
And so I would say an internal win is when you're able to aim up and get and grow character and habits that allow you to have more discrete wins.
Right.
So that is like, that was mind-boggling to me. Is like, hey, when things are good, it's not because I'm good. When things are bad, it's not because I'm bad. And then, whether it's being a dad, being an investor, being a husband, it's like, what am I doing to get better at the continuous process? And then can I take discrete losses and make that and allow me to become better in the continuous process?
Right.
And so now,
love it.
To kind of continue to demystify this Wall Street stuff, let's talk about risk. Now, this is from the book. This is the definition of risk. Risk is the probability of suffering a loss, possibility of suffering a loss. It's called probability only if you can assign a numerical value to likelihood of the loss. Now, when I hear probabilities in the markets, I think it's crap. I think it's a numbers fugazi. And then this is from Nassim Taleb too. It's whenever I make an investment, I got to be comfortable that I'm fine with losing that I have a no loss and I'm comfortable losing it. And if I'm not, do not do that deal.
Yeah.
And now on the backside of risk, remember, risk is the possibility, not the probability, the possibility of suffering a loss. Luck is simply the possibility of enjoying a game. You know, you've heard people say you make your own luck. I do think you can set up circumstances and things around you so that success and luck is just inevitable.
A little bit of Moneyball approach.
Yeah, but it's possibilities.
Mm-hmm.
You know, some of the more technically minded people and the detail minded people, they want to know probabilities.
Mm-hmm.
Probabilities are just math in a sheet. It's not real life.
Right.
And that's from Nassim Taleb. We're going to do next episode on anti-fragile and whatnot, but that's straight up from him.
Yeah. Okay.
Now here's another term, inherent risk. Inherent risk is a natural occurrence in both unorganized and organized markets. So when I deployed overseas and we went out on a mission, it was just understood that there was inherent risk. That's why we wore helmets. That's why we wore body armor. Like, no one was shocked about the fact that jumping out of planes and roping out of helicopters could result in bodily injury. But it's a natural occurrence of that unorganized market.
Yeah.
You know, every time you step into a car, you're at risk for a car accident. There's natural risk in that unorganized market.
Right.
So basically, it's just like if you're breathing, you're living, it's coming with the possibility of loss or a gain.
I remember during COVID, there was a school that I follow, a boys' school, and they have a tree outside that the kids can play on. And it's like a huge, like, big oak tree. It's awesome. And so then when COVID happened, they sent the message to all the families, like, hey, we're still going to have the school open as much as possible because, you know, we have this tree to allow the kids to play. And so, like, we're not afraid of risk. Safety was not, like, one of our
we could do, like, 3
criteria.
episodes on the shenanigans of safety culture.
Yeah.
Well, you know what? I'm going to get into that in a second. I'm going to come back to that.
Okay.
So now you have inherent risk and you have created risk.
All right.
Created risk is a risk that is not a natural byproduct of an activity of itself. So you can spin a roulette wheel without there being any risk or any money at stake, right? You could play football. I never bet on sports. I rarely actually gamble. I'm going to get into that too. But football can be played without any gambling.
Mm-hmm.
When you bet on a gamble, you just created risk. When you bet on a football game, you created risk.
Right.
And a horse race can be run without any monetary loss incurring, but people create risk for entertainment, essentially.
Right.
So why is there so much talk of gambling in the financial industry? Now that we have those definitions, let's get into that.
Okay. Huh.
So this is the Moynihan definition of betting. Betting is agreement between two parties where the party proved wrong about the outcome of an uncertain event will forfeit a stipulated thing or sum to the other party. One more time. Betting is agreement between two parties where the party proved wrong about an outcome of an uncertain event will forfeit a stipulated thing or sum to the other party. Therefore, betting's about being right or wrong. Like, I bet the Chiefs are going to win. I want to be right in an uncertain event.
Right. Okay. So, and that's different from, for example, a contract. Like if I have one of my employees and, you know, we have some incentive in place, I want them to succeed. I'm not looking to be proved wrong. I want them to succeed. We have a win-win situation going on. Betting is always like a lose-win situation.
Yes. Yeah.
Okay.
It's not win-win.
Okay.
Now, gambling is a derivative of betting. To gamble is to wager money on the outcome of a game, contest, or event, or to play a game of chance for money or other stakes. So, derivative of betting, it's to wager money on the outcome of a game, contest, or event.
Okay. So
It's about being right about that game, contest, or event.
So betting isn't necessarily monetarily.
Correct.
Okay. But gambling is monetary. Okay. All right.
So
I'm clear.
betting's about being right or wrong on the outcome of an event.
Right.
It becomes gambling once you introduce cash.
Right. Yeah, you could bet anything. You could bet, hey, you got to shave your head or whatever.
Not
right?
gambling at that point, just betting.
Yeah, got it.
Now here's where we get spicy. Accredited investors, if you're looking for quality real estate to put in your portfolio that is pushing 30 to 40% in annual returns, well, I'm glad you're watching this ad, because I bring my investors about 400 of those deals every year, and all the due diligence is already completed. We also have all the lending lined up, and we have the construction and property management already set and ready to go. And it's all in-house, all done start to finish by my team. All you got to do is review the deal, write the check, show up at closing, and you're done. And the best part is there's no equity splits. You own the asset 100%. My team gets paid to do the things you were already going to pay for anyway, like having someone find the deal, fix up the deal, and manage the house for the long term or offload the deal for a flip. So if you want to invest in real estate and you want to build a portfolio on autopilot, or maybe just flip a few houses with a vertically integrated team doing all the work for you A to Z, click the link. There's more information on how this works on the next page and the option to book a call with us to discuss working together. Now here's where we get spicy. Investing is parting with capital in the expectation of safety of principal and adequate return on the capital in the form of dividend, interest, or rents. Since the return on capital takes the form of periodic payments of interest or dividends, investing indicates an intention to be separated from the capital for an extended period of time. Therefore, investing is usually associated with a long time horizon. There's nothing about being right or wrong in any of that definition.
Right.
What the key things I take away from this, it's being departed from the capital for an extended period of time and getting my return in the form of dividends, interest, or rent. And long time horizon.
So the expectation of safety of the principal is, can you break that down? Like, isn't there always some kind of risk?
Very minimal expectation of loss.
Okay.
Very minimal possibility of loss. All investing requires risk.
Right.
But it's a very minimal possibility.
Sure. All right. You would never invest without expectation of success.
You would never invest. So where an investor can get disappointed, so it's catastrophic for an investor if he loses his initial investment. Mm-hmm. Generally, where you see unhappiness in investors is their return isn't high as they wanted, but they always get their principal, their original capital back.
Right. Okay.
Now, it's catastrophic for an investor if they actually lose capital.
Yeah.
So now the media's definition of why I think there's so much confusion on CNBC and all that stuff is the media's definition of investing is parting with capital by any means and getting the original principal back, plus some more, regardless of the risk the original capital was subjected to. Right?
Yeah,
they don't care. All they talk about was the rate of return. They don't care what the initial risk the capital was subjected to.
All right. That's so funny. That's how they talk about it. Yeah.
Like the whole conversation with crypto right now and people becoming crypto millionaires. Like, cool, that's great. They made a bet and they were right and good for them. But they didn't invest. And they did put their original capital to a lot of risk.
A ton. Yeah. Wow. Okay.
And now technically, let's get into crypto in a second here too. Now let's talk about speculating. This is where a ton of the confusion comes from. Speculating, its simplest form, is buying for resale rather than for use or income, as in the case of commodities, financial instruments, respectively. Speculating is parting with the capital in the expectation of capital appreciation, really in the short term.
Okay. What's coming up for me now is we always talk about, like, America is a country founded by real estate investors for real estate investors. But when I read the history books, it's almost like they were doing a lot of real estate speculation just because the country was so new and fresh and you didn't know if they were actually going to build in these different areas.
So the way I break this down for people is like, take a look at my business. Wholesale, I fix and flip, I carry rentals. And so when I'm flipping a house, am I betting, speculating, gambling, or investing?
Investing.
No.
Okay. So when you're flipping a house,
Yeah.
because there is a possibility of losing that initial principal?
Yeah.
Ah.
And why am I buying the house? Am I buying it for use? Am I buying it for reinvestment? When do I realize my return on a flip?
When you sell it.
Right. So I'm speculating. I'm buying that house for resale, not income or use. I'm buying it to resell it and get capital appreciation in hopefully close to 90 days.
Mm-hmm. Mm-hmm.
So when I flip, I'm not a real estate investor. I'm a real estate speculator. Nothing wrong with speculating. A bunch of people make a ton of money doing it.
Yeah.
I think it's important for new people and experienced people to just know what they're doing.
Right. Okay. Huh.
Now, the other definition I didn't bring in, I didn't bring in trading. But trading is you're trying to become not long nor short on the asset. You're just trying to create a A to B, B to C spread.
Mm-hmm.
So you see all those guys on the trading floor in Wall Street. They'll hold an insurance. They'll hold a equity for like seconds.
Yeah. Yeah.
Now, when I wholesale, what am I doing? Betting, gambling, investing, trading, or speculating?
So in this case, like, do you have any clause in the contract that's protecting you? Like, if you can't find
No.
an end seller? Okay. I guess you're still speculating?
No, on these, I'm trading.
Oh, yeah, sure. All right, that makes sense.
I'm just creating a bid-ask spread between the price I get the house from the seller and the price I get from the buyer.
Okay.
Now, when I carry a rental property, what am I doing?
Investing.
Because I have a long time horizon. I'm planning on using it for income, and I'm going to get my original capital back plus rents and dividends.
Okay. So, when we talk about the 4 pillars, and you say, like, cash flow is important, but it's not the most important. If it's not cash flowing well, but it's still going to appreciate over the long term, is that still speculation?
Somewhat, yeah.
Okay.
Yeah, that's a good distinction.
Interesting.
Yeah, that's a good point.
Like you said, nothing wrong with speculation, especially when you got the full force of the U.S. government behind those mortgages.
Exactly. Now, notice there was nothing about being right and wrong in the definitions of speculating and investing.
Mm-hmm. And no internal risk either.
Right. So when you buy a stock thinking it's going to, well, I kind of already went through this. So this is straight from the book. Markets and gambling games are similar only in that they involve the possibility of monetary loss.
Okay.
That, to me, like cut through all the confusion. It's like, oh, they're similar, but here's the distinctions. And the similarity is that they involve the possibility of monetary loss.
Mm-hmm. They each have created risk. Is that fair?
Yeah. Yeah. I don't know if...
Like, no one's holding a gun to your head and saying, hey, you got to, invest this money in Wall Street.
No, but you do have to invest the money. So, like, if you have cash, you're either going to spend it or invest it. So I think just there's inherent risk to investing. I don't think it's created risk. Now, I do think walking into a casino is created risk.
Right. Okay.
The other thing is gambling. Gambling creates risk. I think investing assumes and manages the risk that's already exists. Like if you want to become wealthy, there's going to be certain places you're going to have a possibility for monetary loss, and it's just part of the game.
Yeah, okay, that makes sense.
Not an extraneous part of the game.
Mm-hmm.
So, just for the audience, one more time. Gambling creates risk. Investing assumes and manages risk that already exists.
Right. Nice.
So, I wish somebody would have known this before. Like, a distinct thing that came out of reading this book is he's like, salespeople generally make poor investors. Because when you're a salesperson, like I was, it was always about being right or wrong. Being right, convincing, persuading the person to get the sale.
Mm-hmm.
And so essentially then, investing became about my ego and my internal wins and my internal losses. And so I had to decouple my internal esteem for myself with my tactical investing decisions. So this is straight from the book too. The distinguishing characteristic of a gambler or bettor is whether he or she wants the satisfaction of being right in his prediction or the entertainment and participating in respectively. Like, I have bought bad deals because I truly wanted the adrenaline rush of participating. And then my ego wanted to be right.
Yeah.
So technically, you could be flipping and wholesaling and investing in rental properties. And if you're doing it to be right, if you're doing it to satisfy your own ego, you're betting. You're not an investor. I had to learn this the hard way.
Oh man, I see these people all the time. Gosh, it's like, and mostly it's in like the sports world where it's like it's really about just the satisfaction of being right, and they forget about the times they were wrong and they focus on the times that they were right.
Yeah.
So, it makes so much sense not to bring that mentality into like the investing or business world.
Exactly. It's really hard to do. It's really hard to do. You got to be very detached. And it took me a long time, and I'm still working on it.
Yeah.
So this is another thing from the book. The distinguishing feature of gambling is that it deals with the unknown with pure chance. And then money is the ticket to the game. And so when I also would look like, oh, money's the ticket to the game, it made sense when me and Susie go out for a date night and we go to a casino and play blackjack. And like here's what we do. We go to the ATM and we'll take out $250. And when that money's gone, date night over. But it's essentially a $250 ticket to entertainment. And then if we win money, we got free entertainment.
Right.
And so if a person, this is back to the book, if a person approaches a business risk or risk in the financial markets for excitement, then he is gambling, regardless of how much control he supposedly has over the outcome.
Woo!
See why we had to get really precise in our speech?
Yes. Yeah, absolutely. And that's where like so much of this like really good stuff starts to come out when you make these distinctions.
Correct. So for Moynihan, manage your exposure. The probability of market events is not open. This is beautiful right here. The probability of market events is not open to any kind of numerical evaluation. Like, I'm sure the probability of a coronavirus was like 1% on the day we woke up and discovered there was a coronavirus.
Right.
Like, the numbers were completely useless.
Right.
The probability of a terrorist event in 2001, like, who cares what it was? Bottom line, there was a black swan event.
Right.
So all you can actually determine is the amount of your exposure as opposed to the probability that the market will or will not go to a certain price. What does that mean? Manage your exposure? Whenever you invest or gamble or speculate, just make sure you're comfortable with the loss.
Yeah.
And don't use probabilities to say, hey, I'm comfortable. And so therefore, all you can do is manage your exposure and losses, not predict profits.
Right. Okay.
Next episode, we're going to get into how wealthy invest with a known downside and unlimited upside.
Okay. Nice. I like that. That probably will answer my question.
Because, yeah, it's an hour long to that answer. But a quick teaser from Nassim Taleb is, this was huge in my development, this line. Return on investment is irrelevant if the risk of ruin is present.
Yeah.
So if you could potentially lose all your investment for like a 5 or 6%, even up to a 10% return, I won't do it. if there's no downside, if there's no cap to my downside,
Right.
no insurance, no put, no nothing I can put on that.
Mm-hmm.
And doesn't matter what the return is. I don't even look at the numbers. I'm out.
Is that why you're not in the market?
Yes.
Because you can't lose it all, right?
Yes. And with real estate, I get to use other people's money, and I still have sticks and bricks. And then that's why, sure, buying insurance cuts into my cash flow, but I don't care because it eliminates my risk of ruin. A house can burn down instead of that a house, and I get a fat insurance check. By the way, that's happened to me. But
did you learn the hard way on that one, or did you win?
What's that?
Did you learn the hard way on that one?
No, I had insurance. I got cash. I made a gain.
Yeah, nice.
Because I was essentially insurance is a put option, and I exercised my option, and so the insurance company had to buy my burnt down house for the price they said they would buy the house.
Oh yeah, nice.
And so another unspoken advantage of real estate is the risk of ruin is so small because you're using other people's money. Someone could lose, and historically, it's always been the banks.
Which is why the government backs it.
And so next episode, we're going to go a little deeper into this. But as a passive investor, and that's who this podcast is for, all you can do really is have your buying criteria and have a plan. Because participating to be right is betting. Betting for excitement is gambling. And in order to be investing, by definition, you have to have a plan. Plans eliminate the emotional response. Plans allow you to play the continuous game and have the continuous process so that you have a discrete loss. You can still have a continuous win. But that only happens with a plan and a criteria. And so if you're a passive investor listening to this podcast, it can be frustrating to be passive because you can't just jump in and do things. But all you really can do is have a buying criteria and have a plan.
Yeah.
And then further refine the buying criteria and plan and learn lessons.
Man, this is great, Jimmy. I really hope they jump on and get on this course or jump on a call with your team and figure out this is the right fit for them. It makes so much sense.
But this is really hard for me to explain in Instagram ads.
Yeah.
It has to be long form content. I had to reread this book 4 times, then read Anti-Fragile twice to understand it.
Yeah.
But I was connecting dots, and it was oh
Right,
my God,
right,
what?
right.
Huh? And so the next episode, we're going to go through Anti-Fragile and Skin of the Game.
Nice. Okay. Sweet.
All right. Well, I think that we are done, Jake. I'm a little tired. But
I like it.
When you have to get into this much heavy definition of terms, it is mentally exhausting.
The Jordan Peterson precision with your words, but I think that it really laid out a good foundation. I think people really like it, so I hope they'll share this episode if they did. I mean,
cool.
If a lot more people knew this, we have a lot less GameStop nonsense.
Well, yeah, and then whenever I'm about to make a financial decision, at first I check myself. Am I doing this to prove I'm right about something? Am I doing this for entertainment or excitement? Nothing wrong with doing it, but just declare to yourself, hey, I'm gambling right now.
Yeah.
And if I'm using my family's financial funds that Susie and I have agreed to only go for investing, I got to opt out.
Yeah. Nice.
Cool. Well, if you found value in this show, please like, share, and subscribe, and leave a comment. Even if you don't want to work with our team, maybe you're not ready to invest, drop us a comment, give us a share, give us a like. But if you do want to work with us, hop on the link. What's the link? What's the link, Jake?
JimmyVreeland.com/get started with real estate.
Get started with real estate. So if you like what you heard today and you want to learn more, sign up for a discovery call with one of the Vreeland Capital success coaches at JimmyVreeland.com.